Good afternoon, everyone. Welcome to our second investor presentation for Dhofar International Development and Investment Holding Company, DIDIC, covering the financial results for the year ending 31st December 2022. If you would allow me, we will run through a brief presentation, and then we will take any questions any of the participants might have at the end. So just a brief overview of the group. As many of you are aware, DIDIC is an Omani investment holding company established in 1987. We are currently the second largest company investment company in Oman, with a total investment book of 215 million riyal. Our investments are in a variety of sectors, the most important of which are in banking, financial services, insurance. We also have investments in manufacturing, utilities, hospitalities, medical supplies, among others. Major investments, as many of the participants would know, would be our investment in Bank Dhofar, where DIDIC is the promoter and the largest shareholder in the second largest bank in Oman. We're also the promoter and the largest shareholder in Dhofar Insurance, which is the second largest insurance company in Oman by GWP. We are also the largest shareholder in OIFC, the leading services and payment services company in Oman for billing, collection, and debt factoring for utilities. Major shareholders come from a number of prominent groups, first of which is Muscat Overseas Group, FinCorp Investment Group, Militant Trading and Contracting, in addition to a number of government pension funds, such as the Civil Service Employees Pension Fund and the Royal Oman Police pension funds. Many of these shareholders are actually promoter shareholders of the company and are the founders. Just a very quick overview. We have a board of 7, chaired by Sheikh Khalid Al-Mashani. Our deputy chairman is Mr. Tariq Al-Ajeli. We also have Mr. Rashad Al-Battashi, who was previously with the Civil Service Employee Pension Fund, Mr. Omar Al-Sheikh, Mr. Salim Al-Awadi, Mr. Faisal Al-Yusuf, and Sheikh Saud Al-Mashani. We are privileged to have highly experienced board members with a number of board positions in very prominent companies in the Sultanate, vast experience across the number of industries that we are invested in. With respect to the management team, the three people present for this meeting, myself, Ramiz Al-Amoudi, CEO, Mr. Vishal Makwana, our Chief Financial Officer, and Mr. Jamal Kamel, the Company Secretary and our Compliance Officer. A very quick overview of our investment philosophy and process. As everybody is aware, our focus is generally to invest in equity instruments issued by new and existing companies in Oman. We generally invest in very select and pre-approved sectors that are discussed with the board and the NRC. We do strive to have exposure to investments outside of the borders of the Sultanate, with a limit of 10% of our aggregate investments allowed to be invested in securities outside of Oman. We have a pretty rigid asset allocation plan based on a number of guidelines, including return requirements and risk that is pre-agreed by our NRC and the board. And we strive to maintain our capital allocation to remain in line with that plan. With respect to the process, investment plans are submitted to the NRC for approval. The plan includes both investments that we want to make, investments that we seek to dispose, along with the rationale for all. Our investment performance is evaluated quarterly. Management does the evaluation, and the results of that are reviewed and presented to the NRC. Any changes to the investment plan based on our reviews are requested from the NRC and could potentially be elevated to the board for decisions. Our actions are followed up by the NRC on a quarterly basis, and any deviations from that are either approved by the NRC or explained. We do carry out a pretty thorough risk management process. We generally follow a scenario analysis framework to determine the risk per investment and across the portfolio. We generally we manage our risk, or we determine the risk tolerance for every asset class by focusing on a maximum loss that we are willing to tolerate. And that is monitored through the monitoring process as previously described. A brief overview of our major investments, or the breakdown of our portfolio. We are in possession, or we own 3 fully owned subsidiaries: Dhofar Investment and Real Estate Services Company, Garden Hotel, and Dhofar International Energy Services Company. The total value of those subsidiaries on our books as of December amounts to 3.16 million riyal. None of them are listed, and so the market value is equivalent to the carrying value. With respect to the associates, where we own anywhere between 25 and 46%, Bank Dhofar, Dhofar Insurance, a financial services company, Oman Investment and Finance Company, Salalah Medical Supplies, and Oman Vegetable Oils and to account for our investment in associates, and that is the result of, and that's how the deviation between market value and carrying value arises. We also have an investment book of equity listed on the MSX, amounting to 26.2 million. The major investments within that portfolio as of December include shares in Bank Muscat and Salalah Port Services, Dhofar Tourism, and Dhofar University, among others. We have a limited exposure to fixed deposits. However, we do have about 6.7 million as a combination of investment in fixed deposits and loans to subsidiaries. A little bit of information on our key investments. The largest investment that we own is our investment in Bank Dhofar, where we own 24%, carried at 137 million in our books. As we've previously stated, Bank Dhofar is the second largest commercial bank in Oman by assets. It was established in 1990 and so has more than 25 years of operating experience. It operates a network of 70 branches, 60 of which are conventional, 10 are Islamic under their Maysara brand. The bank has total assets of 4.3 billion riyals, with shareholders' equity standing at 561 million as of the end of December. Shares are trading at a slight discount to their book value, so the market cap as of December amounts to 524 million. Second major investment is back in 1989. It has a network of 42 branches with 7 regional offices. For the year ended December 22, they generated a GWP of 65 million, and carried an investment book of 56 million, with a market cap of 22. Third major investment is our investment in OIFC, where we own 38%, carried at a value of 10 million riyals. OIFC is one of the leading services company specializing in billing, collection, and debt factoring. It's established all the way back in 1979 and so has been in operations for about 40 years. It has an investment book that includes a 15% stake in Sohar International. Including Sohar International, other investments, the total investment book of OIFC amounts to 116 million. The book value of the company amounts to 32 million riyal, and the market cap is 31 million as of the end of December. With respect to the 3 subsidiaries, the first one is Garden Hotel. Garden Hotel is an entity that fully owned subsidiary that owns the Garden Hotel located in Khwair, 153 key property, 3 stars, previously operated under the brand of Tulip Inn. Dhofar International Energy Services entity is the subsidiary that we use to invest in the utility sector. It has shareholdings in 4 projects: Dhofar Generating, Al-Dahira Generating Company, Shinaz Generating Company, and Dhofar Desalination Company. We are minority shareholders in all of these and are partnered with internationally renowned operators and developers of utility assets. Dhofar Investment and Real Estate Services Company no longer is not operational. It previously held an investment that we exited last year, and so the company as of now is a shell company for the time being. Just a quick overview of the financials of the group that have been announced and released on the MSX. As you will note, our total income has declined in 2022 as a result of a fall in some of the dividends that we have received. We have to note that the dividends that we collect from our associate entities do not fall within this income line, as we account for our share of profit through associates. So this includes the income or the dividends received from our equity portfolio only. Expenses are pretty much in line with what they were at last year, with a slight increases as a result of the minimum increase to salaries and recruitment of a few additional resources. We have witnessed a significant decline in finance expenses during 2022 as a result of both the conversion of the sub-note that we did last year. So the first half of 2021 included additional interest of about 1.2 million on that bond that was converted in the second half of the year. And we also have a reduction in the actual interest rate applicable to our loan, and that explains the decline in finance cost. The share of profit from associates has witnessed a significant increase. As a matter of fact, all of our associates have reported improved profits in 2022 as opposed to 2021, as will be shown in a later slide. Resulting in the profit before tax more than doubling to slightly less than 10 million riyal, and with a profit after tax reported at 9.7 million. Including comprehensive profit, it's 10.2. The comprehensive profit arises from the classification of certain investments. If we look at the balance sheet size has reduced from 224 to 218 million. Mostly as a result of certain exits we made during the year from our trading portfolio. Equity has increased from 120 to 128 almost as a result of the profitability of the year. As you can see, our loans and borrowings have declined by about 11 million riyal as a result of 2 payments that were made last year to our senior lenders as repayment of a partial repayment of our loans. A graphical representation of what was previously discussed. So total income has declined by 12%. Once again, this only relates to dividends that we receive from our portfolio entities and does not take into account the performance of our associates. As we noticed, our share of profits from associates increased by almost 50%, which had a significant contribution to the increase in overall profitability. That in combination with the 29% decline in finance cost. Our total expenses, as stated, are almost flat with a 1% increase. On the right side, just to highlight the share of profit booked from associates. As mentioned earlier, the profit from all of our associates in 2022 has gone up as compared to 2021, with notable increases in Bank Dhofar and OVOD. With respect to balance sheet size, obviously the profitability of our associates and the accounting methodology applied to that results in an increase in the value of our investment in associates. Our profit obviously lead to a 6% increase in shareholders' equity. Debt has been reduced by 11% as a result of the 11 million riyal repayment effected during 2022. Other liabilities have declined significantly by 74%. And that mainly relates to the reduction in accrued interest. As everybody might be aware, during 2021 and 2020, companies, including DIDIC, availed of the CBO directives to restructure debt and defer interest payments. And as a result, we had reported accrued interest in our books in 2021. In 2022, all interest is paid and current, and so that accrued interest has been repaid. Just a highlight of the performance of some of the major investments. So the major one, obviously, is Bank Dhofar. Just to highlight, we are quite pleased with the performance of Bank Dhofar. We are seeing the fruits of the labors of management over the past few years beginning to show. So we can see that the net interest has gone up by 20%. The net interest margin comes up to 2.5%, which is a significant increase to where it was last year, closer to 2%. Net provisions have increased by 28%. This is a continuation of the bank's policy to de-risk its loan book. And we hope that, and we expect that future years will show lower provisions as a result of de-risking, reporting higher profits and thereby higher dividends. Despite the significant increase in provisions, we still see a 36% increase in profits after tax. We also see a minor increase of 2% in the bank's overall loan book, despite a slight reduction in deposits. The improved performance has resulted in a 3% increase in shareholders' equity. As you will note in the commentary on the right side, the bank still maintains a total capital adequacy ratio of 17.6 and the Tier 1 ratio of 12.9, both of which are significantly higher than what the regulations require and are in line with what the bank's position was last year. The bank is also very healthy with respect to its LCR and stable funding ratios. Dhofar Insurance continues its story of growth. So we see an 18% increase in the top line, the DWP, from 55 to 65 million. Operating profit has increased by 41% as a result of better cost management and underwriting activities, resulting in profit after tax increasing by 47% to 3.8 million. As you can see in the bottom, the insurance funds remain almost where they are. That obviously results in a slight decline in the reinsurance share of the insurance funds, given taking the GWP growth into account. However, the company's performance remains very positive and stable, with shareholders' equity increasing by 9% and dividends being declared for another year. OIFC's position is very stable. Its revenue is almost in line with where it was last year. However, we have witnessed an increase of 26% in their EBITDA as a result of better cost management and better arrangements with the principals, resulting in a 26% increase in profit after tax. Investment in associates has gone up by 36% as a result of the company's continued maintaining its share of ownership in Bank Sohar by participating in the most recent rights issue. Most of that was funded through borrowing, and that resulted in an increase in the company's borrowing by about 28 million riyal, or 48% over the year. Shareholders' equity remains almost as it was. If we just take a look at DIDIC's own progression in terms of borrowing and shareholders' equity, as we can see, our shareholders' equity has increased by 138% since 2019. A big factor for that increase in equity is the change in accounting methodology for associates that was implemented in 2020, which resulted in a bargain gain of about 40 million riyal being booked that year, and that contributed to that significant increase of equity in that year. At the same time, our borrowings continue to go down as a result of, one, the conversion of the sub-note of 25 million that took place in 2021, and the repayment of 11 million riyal in debt in 2022, bringing down our overall debt to about 80 million riyal. Just in conclusion, we would like to highlight that our key investments are all showing signs of improvement with increasing profits and distributions. We expect future improvements to even outshine what we have experienced this year. The general upward movement in the MSX, the improvement in Oman's credit rating, the opening up to FDI is all leading to improvement in our profits from our portfolio. Our current borrowings at 80 million riyal are manageable. They are within the company's ability. We are abiding by all covenants relating to our debt. With respect to our future action, obviously there's a number of initiatives that have been launched or being studied by DIDIC, including the potential merger with OIFC that will be discussed in a separate session once that situation progresses, and some other transactions with other related entities. All of these will be reported to shareholders and the market at large once the plans crystallize and become more meaningful. I thank everyone for the patience, and I'll wait for any questions you might have. So it took about 15 minutes. 20. No question. If there's no questions, thank you, everyone. We will be uploading this presentation to our company's website, and we are ready to answer any questions shareholders and MSX, obviously. Thank you very much. Have a good day.